On Business Incorporated today, World Bank lifts its growth forecast for Sub-Saharan Africa. Moderna to build state-of-the-art facility in Africa to manufacture up to 500 million doses per year. And Google is set to invest $1 billion in Africa. Hello and welcome to the program. I'm Ini Jonmekwa. We begin with intraday market numbers from the African continent. Nigeria's NGX traded higher by 0.15 at intraday, while South Africa's main index soared higher by 0.72%. That was also at intraday. Positive sentiments also trailed to Egypt's EGX 30. It was up almost 1%, while the Nairobi Stock Exchange closed Wednesday's trading session negative. And moving out of Africa to Middle East, where trading was mixed at intraday. The Abu Dhabi and Dubai's indexes carried the green flag at intraday. It was 0.51 and 0.73% each. And Saudi Arabia and Qatari indexes traded bearish at intraday. We'll move to Europe now, where stocks rebounded in early trade, continuing a week that has seen wild swings in global market sentiment and trading. The energy crisis remains top on the headlines. Well, we have Chelsea joining us now from Frankfurt to give us details of what's going on there. Hello, Chelsea. Good afternoon.
Good afternoon.
So, Russian President Vladimir Putin has offered to send more natural gas to Europe as the continent faces an energy shortage. Has this helped in any way? Has it helped the markets?
It has. We've seen natural gas prices come down quite significantly today, at one point down about 20%. And that's after we saw one of the most dramatic days of trading for the European natural gas markets in history. It was up about 40% at one point yesterday. So we are seeing some of that air come out of this bubble, and it's largely being attributed to these comments from both Vladimir Putin, the president of Russia, and some of his deputies as well. Basically what they're saying is that they are prepared, they are willing to send more gas to Europe. They've mentioned a couple different ways that they could do that, and that's really crucial because Russia is the biggest supplier of natural gas to Europe. They usually account for about 40 to 50% of all natural gas imports into Europe. So this is something that could really help ease the supply constraints that we're seeing. And also, we've seen a lot of criticism of Russia because they haven't been raising supply to Europe in the way that many had expected as we see the economy bounce back. So some had accused Russia of using its gas supplies to force Europe to approve the Nord Stream 2 pipeline that was just built connecting Germany to Russia. But whatever the reason that Russia is doing this, traders are definitely happy to hear that they're willing to increase supply heading into the winter.
Yeah, well, we do hope they increase that supply because it's not really been looking good. But backlogs are growing at major European ports that are threatening to create new supply chain issues. How serious is the situation?
The situation is definitely getting more and more serious. Basically, what we're seeing here in Europe is a flood of cargo ships coming into ports around Europe, including at the Hamburg port here in Germany, but also in Rotterdam and Antwerp, so the Netherlands. These are really key conduits for goods, particularly coming from Asia. So it's a major supply chain line, and it does appear to be stretching right now. The main reason for that is because, as we saw earlier this year, there was a lot of congestion at Asian ports because of various issues, including the Suez Canal blockage earlier this year, as well as the Chinese ports shutting down at various times due to coronavirus outbreaks. So all of those ships that had been backlogged in other parts of the world are now starting to come into port, and these European ports just can't handle the volume. So we're seeing a lot of delays in supply chains. That's really going to ripple through the economy, which is already really struggling with other types of shortages shortages of commodities, of energy, of semiconductors. So a lot of businesses are growing more and more concerned that not just that prices could increase, adding to inflation worries, but also that we could start to see empty shelves and actual shortages as we head into the winter for some goods.
And European Central Bank is looking at new stimulus measures after its emergency pandemic fund ends next year. Do we have an idea what this will look like?
So what we've seen from the European Central Bank is that they're preparing some other type of stimulus effort to sort of tide the economy over, to keep some support flowing after its main emergency support measures run out. So right now, the ECB is basically flooding the market with purchases through this $1.8 trillion pandemic response program. They're using that to buy bonds of corporations, of governments, and they're keeping borrowing rates low. But that's going to end in March, and so they are planning some other type of stimulus effort, likely to be another type of bond buying program where they can make really targeted purchase of the debt of, for example, a country like Italy if it starts to come under distress. So right now the big question markets is when the ECB, when the Federal Reserve are going to start paring back stimulus. But I think this shows that the ECB is definitely preparing not just for some of its programs to end, but also for continuing to give support to the economy here in Europe for a much longer time.
All right, Chelsea, thank you so much and enjoy the rest of your day. So let's move over to the UK now. Business Secretary Kwasi Kwarteng is speaking at the Energy UK conference. Just after the Energy UK comes CEO Emma Pinchpick point out that they've been warning about retail suppliers for a long time, but nothing has been done. Well, we talked about the issue with the energy and gas prices this morning with Juliana. She joins us now to give us update of the situation. Hello, Juliana. It's you and I again. Good afternoon.
It is always a pleasure. Good afternoon, Annie.
Yeah, so the energy crisis, of course, is a dominating headline today in the UK conference. What's Kwasi Kwarteng saying?
Yes, unfortunately, a little bit thin on the detail, I'm afraid, because this conference hasn't been taken live, but I've been trying to scale through some tweets from some journalists that are there. And really what the Business and Energy Secretary is saying is a doubling down of what he's been saying before. Yes, Britain is currently facing an energy crisis, as is Europe, but of course it's affecting us a lot more because we rely on gas to heat our homes a lot more. I think one of the biggest issues that he addressed is competitiveness, and the fact that a couple of weeks ago the industry was up in arms because the government failed to bail out lots of these smaller energy firms, and Kwasi Kwarteng said that's exactly the right thing to do. That really it was the media that was kind of hyping up the disastrous nature of the story, because every year so many smaller gas firms come into the market and they're just unable to survive because they're promising customers that they'll be able to pay a certain price, and when gas prices, wholesale gas prices rise, which is what we've seen over the past couple of months, they aren't competitive enough. Also, and most importantly, the political line really is that the British government, the Conservative government, will protect consumers. That is the plan, that's the pledge. They have stuck with the price cap, which they were told they should raise by energy bosses. They didn't do that. They do say that they want to prevent fuel poverty, which is what the charities are decreeing that there will be over the next couple of months. And also he said that the energy markets must remain competitive. Hopefully there'll be a press release released later this afternoon, which I'll be able to share with our viewers tomorrow. But so far, that's all we've gotten from Kwasi Kwarteng.
Okay, well, still talking about gas prices now. UK wholesale gas prices dropped in early trading away from yesterday's record highs, and that's thanks to the move by Russia. Has this calmed the nerves in this area?
Yes, it has. You know, just picking up really from what Chelsea was saying, as soon as Vladimir Putin finally spoke and said that he will start pumping more gas through Ukraine, the markets did start stabilizing. But I think, from the Russian perspective, they've been pretty clear that, this isn't a political situation. They're not doing this for muscle. They have contractually stuck to the agreement of how much gas that they were supposed to be flowing into Europe. The only thing is, of course, it's been so cold and there's been so much demand from Asia that supply hasn't been enough. There's also talks now about Nord Stream, which is the very, very expensive, lucrative new gas pipe, which is awaiting a confirmation and a regulatory tick by Germany. Is Putin going to be using this to his advantage? Because he says if they want more gas, then why not use this brand spanking new pipeline? So it is a little bit political, but I think so far, yes, the market has breathed a sigh of relief because, of course, yesterday was at a record high, but now it is slowly starting to stabilise.
And stocks opened high in London in the morning. Is that a sentiment now?
Same sentiment, Innie. The FTSE All Share is up 0.82%. The FTSE 100 is up by 0.96%. And the FTSE 250 is up by 0.13%. In the currencies market, the British pound also doing well, up against the US dollar by 0.04%, up against the euro by 0.06%, and up against the Japanese yen by 0.06%. Also, investors are awaiting the latest non-farm roll pay data from the US, which is probably in now. Lots of anticipation towards that. And of course, as we discussed on Business Morning, house prices. House prices has risen by over £4,500 in just 1 month. So all the top FTSE 100 risers are the house builders today.
All right, Julia, thank you so much for the update. Enjoy the rest of your day.
Thank you.
So we move from UK to Asia Pacific, where shares rose in early trade with Hong Kong stocks leading gains. By Thursday afternoon in Hong Kong, the Hang Seng Index in Hong Kong jumped 2.41% as shares of Chinese tech giants Tencent and Alibaba rose 3.45% and 5.54% respectively. Hong Kong listed shares of Chinese Estate, formerly a major shareholder of embattled developer China Evergrande, surged more than 30% after announcing Wednesday that it had received an offer to be taken private. The Nikkei 225 in Japan rose 0.93%, while the Topix index climbed 0.22%. South Korea's Kospi advanced 1.73%, while Taiwan's TAIEX gained 1.83%. Elsewhere, shares in Australia also rose, with the S&P AX 200 up 0.63%. Mainland China markets remain closed on Thursday for holidays. We head to the U.S. now, where stock futures edge higher after the Dow Jones Industrial Average reclaimed a 459-point loss on Wednesday as investor concerns about a debt ceiling deal eased. Dow Jones Industrial Average futures rose 134 points. S&P 500 and Nasdaq 100 futures were also in the positive territory. October has been an expectedly volatile month, driven by uncertainty about the United States fiscal and monetary policy and supply chain constraints. Although economic data suggests that the economy has already started to climb out of the Delta-driven summer slump. On the data front, initial jobless claims and consumer credit are due out later on today. Move to the oil market now, where prices dropped for a second session in early trade under pressure from an unexpected rise in U.S. crude stocks that raised concerns over demand after prices rallied to multi-year highs. U.S. crude slid 0.67% to $76.91 a barrel after the market climbed yesterday to $79.78, the highest since November 2014. Brent crude lost 0.1% to settle at $81 a barrel. The U.S. Energy Information Administration has said that U.S. crude inventories rose by 2.3 million barrels last week against expectations for a modest dip of 418,000 barrels. Gasoline inventories also rose, while distillate inventories were down slightly. Global oil prices have jumped more than 50% this year, adding to inflationary pressure that could slow recovery from the COVID-19 pandemic and impact consumer demand. Natural gas and coal prices have also climbed. We'll take a break now. When we come back, we'll go to the commodities market. To stay with us. And just before we go to that conversation on commodities markets, I would like to tell you that Moderna Incorporated, a biotechnology company pioneering messenger RNA therapeutics and vaccines, has announced that it would build a state-of-the-art mRNA facility in Africa with a goal of producing up to 500 million doses of vaccines each year at 50 PG dose level. The company anticipates investing up to $500 million in this new facility, which is expected to include drug substance manufacturing with the opportunity for fill and finish and packaging capabilities at the site. The company expects to begin the process for country and site selection soon. Moderna and its partners have ramped up capacity worldwide and have supplied more than 500 million doses of Moderna's COVID-19 vaccine till date. This announcement is a new investment aimed at adding a manufacturing site in Africa to Moderna's expanding global network. While Africa is still receiving attention, tech giant Google has announced plans to invest $1 billion in Africa's innovation journey over the next 5 years. The company's chief executive said that the funds will be utilized to make technology accessible to more users on the continent. Africa, despite commanding a market of 1.2 billion people, remains at the bottom of the global digital economy value chain, and that's because of high costs of mobile and fixed internet that are expensive. Smartphones lock out over half of the population from web services. Google says the investments will focus to bridge this gap by offering faster internet to more people at lower connectivity cost. A subsea cable Equino is planned to run through South Africa, Namibia, Nigeria, and connect the continent with Europe. This will add to the already existing 40,000-kilometer 4G and 5G subsea cable by Two Africa Consortium that connects 19 African countries to Europe and the Middle East. And now to our commodities market update. The global price of palm oil has increased by 7.7% in 1 week, and the 3-month benchmark contract has risen by 32% in 2021. Analysts forecast that palm oil price will close at a record high for a third consecutive day. As a result of this, shares of some of the world's largest palm oil producers have jumped as much as 13%. Well, for more on this, we have Mayo Aige, research analyst with Financial Derivatives Company, joining us to share her thoughts on this. Hello, Mayo. Good afternoon.
Hello, good afternoon. Thank you for having me.
Great to have you. So what's responsible for this surge in the price of palm oil?
Okay, so palm oil, we know palm oil is a very versatile oil and is used across different industries. It's used from cosmetic industry to fast food to fast food industry. And then due to this versatility, we have seen the demand for palm oil increase over the years, especially with the increased use of palm oil in the biodiesel industry. However, in the last 3 years, we have seen that the palm oil production output, there's been a halt in palm oil production output. And this is largely due to the effect of prolonged drought in 2019, wet weather conditions, and also low fertilizer usage. And this has led to a tightening in supply of palm oil globally, and this has led to the increase in price. Currently, other factors that have also driven this price increase have been low production as a result of labor shortages in Malaysia, a major producer of palm oil, as well as export buying by China and India ahead of holidays in their region. And these factors have led to the current rise in palm oil prices that we've been seeing globally.
All right, so when we look at Nigeria is the fifth, we talked about this morning with Dumebi. Nigeria is the fifth largest producer of palm oil, right? Well, we have Indonesia leading. And when we look at the production, we see that for Nigeria, an annual average, it produces an annual average of 5.05 tons per hectare, while Indonesia produces 18 tons per hectare. Now, is there a way Nigeria can meet up with this production, at least to improve our yield?
Well, to be honest, let's give ourselves a bit of credit. We have actually grown our production by about 25% in the last 5 years. But then when you look at the supply-demand gap of about an average of 400,000 metric tons per annum, we see that there's actually need for improvement. And some of the issues affecting this space a major issue is the fact that our plantations are very old, they're obsolete, and then a lot of the yield has declined over the years. Other factors involved are the fact that we use for farming techniques, low use of technologies, and so on. So to improve our current yield, the things that the government needs to actually focus on are: one, the government has to actually provide easy access to land for farmers. Currently, we might need about 100,000 hectares of farmland for palm oil production in order to meet our supply-demand gap. Two, the government actually needs to invest more in our agricultural extension services. We need more staff in that space. We need funding for them to be able to afford transportation and the tools they need to go into the rural areas to educate these farmers on the best farming techniques. And three, the government also has to provide funding, soft loans to these farmers. And then lastly, the government needs to also focus on infrastructure, the road infrastructure, storage infrastructure, in order for us to increase our production and our yield in this space. And with the increase of our production and yield, we would actually have more to export and actually improve our foreign exchange reserves from the exportation of palm oil.
Well, that also speaks to developing the value chain, in palm oil. Well, also, one of the leading causes of deforestation globally is planting of palm oil or palm trees. Now, is there a way to make it more environmentally friendly? So while we try to earn or boost our earnings through palm oil, we don't destroy the environment?
So this issue is not only a Nigerian issue, it's a global issue. Countries all over the world have the same issue. Palm oil has been contributing to a lot of deforestation around the world. In major producers like Indonesia and Malaysia, palm oil production is responsible for about 50% of the deforestation in those regions, right? And palm oil, because of its versatility and the fact that it produces a higher yield at a lower cost than other vegetable oils, it is highly in demand and sought after in many industries. But I think that for us to have more environmental friendly practices for producing palm oil, it's going to involve a lot of government intervention. We would need to see a lot of policies by government in order to ensure sustainable practices for palm oil production. For instance, just yesterday, the US Congress presented a bill in the Senate. It's called the Forest Act of 2021 to track the supply of commodities like beef, palm oil, that actually contribute a lot to deforestation globally. So we need to see more countries coming up with policies like that. And also we need to see more awareness to the local farmers in countries all over the world, letting them see the impact that deforestation is having on the climate generally, and also providing them with improved seedlings so they can still produce more in the same land space. But then whichever way we go or how we go about it, I think it's important to note that we might actually see a decline in production, in the level of production of palm oil when we follow these sustainable practices.
All right, Mayowa, thank you so much for sharing your thoughts with us. Mayowa Ege is a research analyst with Financial Derivatives Company. Thank you so much. So moving on now, the World Bank has lifted its 2021 growth forecast for Sub-Saharan Africa by 1% to 3.3%, citing elevated commodity prices, the relaxation of stringent pandemic measures, and recovery in global trade. This is according to its latest Africa Pulse report. The last Africa's Pulse report, issued in April, had forecast growth of 2.3 to 3.4% this year, after an estimated contraction of 2% in 2020. The World Bank says that economies of Angola, Nigeria, and South Africa are expected to come out of the recession this year. Oil-producing Angola was seen growing by 0.4% in 2021 after 5 consecutive years of recession. Nigeria's growth was expected to be 2.4%, driven by services, while South Africa, the most industrialized economy in Africa, was projected to grow by 4.6% on the back of better performance in services, industry, and agriculture. Well, that's it on the program today. Thank you so much for being a part of it. I'm Ini John Mekwa.